I got a really good comment from Ace. He's one of these supporters of the channel, so shout out to Ace. Thank you for that. He mentions he would like to see a video comparing the two high dividend paying stocks such as IBM, which has a dividend yield of 4.75, or Leggett & Platt with a dividend yield of 4.22, comparing them against a company like Texas Instruments or A.O. Smith that have a much lower yield at a 2.6 or a 1.83. In the long run, which of these companies will give you the higher dividend income over the years? This is an extremely important question, and I think one that a lot of dividend investors, particularly those just starting out, often don't think about.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
A high starting yield today is obviously great, but it may not be as good as a lower starting yield if the lower yield has the ability to grow over the years. So in this video, we're going to take a look at IBM at a 4.7% dividend yield, and we're going to compare that to A.O. Smith, which has a dividend yield right around 2%. Which of these stocks would likely produce the highest dividend income 10 years from now? To answer that question, we need to take a look at the financial statements of both businesses. IBM currently pays $1.65 in quarterly dividends, which amounts to a 4.65% annual dividend yield. The first question we need to answer is, do we think IBM is going to be able to continue to pay as much as they're currently paying? And right off the bat, we can see some disturbing trends here. First of all, just looking at earnings per share, we have a couple of big red flags. The first is that the earnings per share back in 2012 were $14.37, and that is less than half today. It's at $6.35. So our earnings have been cut in half over the last decade. That's a major red flag. The other red flag is that the earnings are actually less than the dividends being paid out. So our payout ratio is over 100%. Any of you longtime dividend investors know that is not something you want to see. The other major issue with IBM is right up here in this chart. Return on invested capital is one of the most important ratios I think Warren Buffett looks at. Honestly, if I had to choose one ratio to look at for any business, only one, I would choose return on invested capital. It tells us how much a business is able to earn on behalf of shareholders for every dollar that it reinvests back in the business. The higher the number, the better. So from 2002 all the way to 2012, this return on invested capital was heading in an ever-increasing direction, and it topped out right here at 31.9% back in 2012. However, since then, it's been going in a steadily worse and worse direction. Typically, you want to look for something at least 10%, but now with IBM, we see return on invested capital has deteriorated to 7.3%. And that tells us that the economic moat that IBM once had, which it definitely did back here over this decade from 2002 to 2012, that has basically completely eroded. So this is a major red flag. Earnings being less than dividends is a major red flag. Earnings being cut in half is a major red flag. We also see revenue has almost been cut in half since 2012. And our dividend growth, if we just take a look at that, we can see that it used to be in the mid double digits, and that has slowly started to decline ever since 2015, down to 10, 7.3, 5.3, 3.5, 1.2, and now 0.6. So this is a troubling sign. Basically, they are not increasing their dividend. I mean, they are, but it's a token increase just to say they increased it. And we've seen a steadily declining growth rate since 2015. So this is just absolutely ugly. If we flip over to the cash flow statement, things actually look a little bit better. So net income is not the same as the actual cash flow the business is generating. The biggest difference is this depreciation number. So depreciation is basically trying to match up your past investments with a time horizon that makes more sense to measure them over. So if you're investing, say back in 2016 and you bought a new factory or something, you're going to use that over the next, say, 10, 20, 30 years. So it makes sense that you would expense that over future time periods. That's basically what depreciation is. And there are certain cases when a business is investing less today than they invested in the past, their depreciation number can actually be higher than what they're currently investing. And with IBM, that's the case. We can look at the cash flow generated from their operations at $11.13 billion. And then we can subtract how much they're spending right now on property, plant, and equipment. And they also pretty consistently spend on intangibles. So if we drop these two numbers out, we'll subtract, say, $2.2 billion from this number. We arrive at a free cash flow number of about $8.9 billion. So this is how much has been left over after they make their investments. And if we compare this number to the dividends being paid, which is right here at $5.9 billion, it looks a lot more sustainable. However, another issue that we see is this net issuance of common stock. This is negative, meaning they were buying back a ton of shares. That has basically eroded to net nothing over the last couple of years. So all you're getting from IBM is the dividend. That dividend, based on cash flow, does appear to be sustainable. However, they're investing a lot less in their business than they were, and we see a major deterioration in fundamentals. So not a pretty picture there from IBM. Let's take a look at A.O. Smith. A.O. Smith pays a 28-cent quarterly dividend, which amounts to just over a 2% dividend yield. When we look at their financial statements, we see a much different picture than IBM. First question, is the dividend sustainable? We see the $1.06 dividend per share right here, and we can compare that to earnings per share, which are right now $3.02. So only paying out about a third of their earnings in dividends, so that is a good sign. We also see substantial earnings growth since 2012. Earnings have basically more than tripled since then. We also see a healthy increase in revenues. And perhaps most importantly, we take a look at this return on invested capital number, and we see two things. One, it's currently 24.1%, which is extremely good. We would need to compare that to competitors just to kind of see where they're at against competition, but that is very promising. We also see a pretty steadily increasing number over the years. So first glance here, this is actually pretty fantastic. And then here on their cash flow statement, we can calculate the free cash flow. So cash flow from operations at $553 million. If we just subtract how much they're spending on PP&E, that gets us to $482 million in free cash flow. Again, plenty of room for the dividend, which is $172 million. They're also buying back a ton of stock, so this negative number means a buyback. Over the last 12 months, they've bought back $407 million and paid $172 million in dividends. We can add this up and divide it by the current market cap, and that gives us a total shareholder yield of 6.72%. So it's pretty clear based on the numbers that IBM's dividend growth is going to be pretty flat, if not declining over the next decade. I wouldn't be shocked if they cut their dividend at some point in the next 10 years. I don't think it's imminent like we saw in the cash flow statement, but it's definitely a pretty ugly picture. Compare that to A.O. Smith, and that business appears to be growing, and they appear to be increasing their returns on capital. Dividend growth appears to have a pretty good amount of room to continue to grow. Plus, they're actually returning more cash to shareholders in total than IBM is if you count the buyback. But the question Ace had is, over the years, who is going to end up paying you more in dividend income? So here we have a chart, and we're going to plot A.O. Smith's dividend yield on one point, so it's a 2.03% yield. And then we have IBM all the way up here at 4.65%. And let's say for our chart here, we're going to go out to 10 years. Based on the numbers that we saw, I would think IBM is going to look something like this. Pretty flat, maybe a modest increase each year, but I don't think you're going to get a whole lot of growth here. So the question becomes, how much does A.O. Smith need to increase their dividend in order for them to eventually overtake IBM after 10 years. So if we put this into a financial calculator, we can compute that A.O. Smith needs to grow their dividend at 8.64% faster than IBM in order to close this gap over a 10-year period. Will they be able to do that? That is for you as the analyst to decide what you think. I think I definitely know where I come out on this equation, but this is why it's important to do financial statement analysis of all the companies that you're considering buying. Sometimes they'll have a big dividend yield today, but the underlying fundamentals are really troubling. Conversely, sometimes you have a situation like A.O. Smith when the dividend yield may be a little bit lower, but you're more likely to get future dividend growth. And remember, over long periods of time, as the dividend continues to grow, the share price is going to have upward pressure on it to move with it. To illustrate why that's the case, you should take a look at this video right here. In next week's video, you all requested that we take a look at which businesses insiders were buying in June. So I have 4 buys and 1 company that they're actually selling or they sold in June. So that will be coming up next week. If you want to get early access to that, you can join me on my Patreon. All supporters get early access to new videos and some additional content, a little bit more technical in nature. So if you're interested in that, please consider supporting me on Patreon. You can also join as a premium member on YouTube. Patreon's a little easier, I find, and you can message me directly. So that's probably the better option, but both are available. Thank you to everyone who is currently supporting the channel. I really appreciate that. Thanks for watching, and I will see you in the next video.